Hi, I'm Linda Eedes. This is an update on the RECM Global Flexible Fund, looking specifically at the fourth quarter of last year, but also talking to 2019 as a whole, looking at how the fund is currently positioned and, of course, the strategy going forwards. So if we look at the quarter, it was really a continuation of a trend for the entire year, which was this very strong rotation into growth-oriented sort of large cap companies, particularly driven in the US by the big tech stocks. So the US equity market was up more than 30% last year. And if you had told someone at the start of the year that that would happen, they would have thought you were absolutely mad, because that does not really reflect what was happening on the ground, but is more a reflection of sort of a continuation of the party, in the sense that interest rates remained lower. That was unexpected at the start of the year. And the interesting thing is that not only equities did very well with that backdrop, but bonds also performed well as gold, which often is uncorrelated or sort of inversely correlated to risk assets. In fact, many investors have gold in their portfolio as a hedge against macro or geopolitical risk, and yet all of these assets performed well. So the Global Flexible Fund was actually flat for the quarter. You'll know that as value investors, we don't participate in the very growth-oriented, high-priced businesses, which are obviously priced for perfection and then some. We tend to try to find the undervalued parts of the market. And a big benefit of that is that when markets actually come under pressure, our funds tend to hold their ground. And the Global Flexible Fund has done that very successfully in the past. Over the last 4 years, the Global Flexible Fund has actually performed very well. So over the last 4 years, it's actually up just under 31% in cumulative terms. And if you compare that, for instance, to the average fund in its category, in the worldwide fully flexible category, the average fund is up 15%. And what's interesting is that the all-share index, which is 100% equities, rather than sort of a fund that is multi-asset classes, was only up 24% over the same time frame. So I think the benefit of our style comes through over various different market environments. And of course, during the sort of market climate that we saw in 2019, if we had performed in line with the market, I think it would raise some serious questions about whether we are actually value-oriented or more growth-oriented. So we continue to invest in a wide array of undervalued opportunities, both locally and globally. We actually have a tilt towards offshore exposure. We have about 60% of the portfolio is actually exposed to offshore assets. There is quite a bit of cash in that offshore portion. That actually came through quite strongly during the fourth quarter, because you might recall that that cash is held in a combination of British pounds and yen. And of course, with Brexit uncertainty reducing, with the UK election coming through, and the likelihood of the UK actually leaving the EU, that actually saw UK stocks rallying. So we benefited from that in terms of exposure to stocks such as Tesco, along with other UK equities that we have in the fund, as well as our exposure to the British pound. Interestingly, the South African rand was quite strong during the fourth quarter. In contrast to how we feel often locally, the rand actually ended the year slightly stronger than it started the year, which I think just gives you a reflection that it was actually quite undervalued to start with. And often, we don't think about how something is priced relative to how we feel about it. And a lot of the sort of bad news with regards to the local climate was already priced into the rand. So that was an interesting development during the course of the year. On the local side, we still have exposure to a lot of small and mid caps. One of the things that came through in the portfolio was our exposure to a company which is a 1.5 billion rand market cap company called Metrofile. Now, this is a document storage company. Like many small caps, it had come under pressure for quite some time, to a point where it was literally trading at such attractive multiples that a US consortium has come in and made an offer to buy 100% of the firm. And that offer was made at more than double what the stock was trading at the time that the announcement was made. So there's been a huge uptick in the price, but because this is a small stock and off the radar screen of many large managers, it's actually still trading at a significant discount to the acquisition price. So this gives you an example of some of the opportunities that are out there. I think we're going to see a lot more consolidation. We're going to see a lot more acquisitions of companies like that, which are just trading at bargain prices at the moment. And that could be how some of the value unlocks in the local portion of the fund. We do also, though, still have exposure to some of the undervalued large caps. And one of the stocks that was undervalued for a very long period of time, but which has seen this very sharp unlock of value, is our exposure to Impala Platinum. Now, that stock is up more than 3 times over the course of 2019, and it's up actually more than 9 times from its lows in mid-2018. Now, you'll know that we've had exposure to platinum for a very long time, and it just shows how rapidly that unlock can happen when things become extraordinarily cheap relative to sort of their through-the-cycle valuation. We did have some exposure to gold as well through the gold producers. We have a gold basket, which is also, again, a hedge against sort of geopolitical and macro risk. That came through quite strongly with gold prices rallying. Our exposure to emerging markets such as Sberbank, which is the Russian bank, also contributed to returns. And then on the detractor side, I think really the main detractor, the thing that sort of kept the returns sort of in check or sort of from participating in the rally, was our exposure to the local SA incorporated type stocks, which still remain under pressure given the economic climate. So there I'm talking about stocks like HCI, Hoskin Consolidated Investments, which has a stake in Soho Sun. Obviously, the game and leisure sector has been under quite a bit of pressure. That is actually probably one of our biggest value opportunities currently. It's trading at an extraordinary discount even to the listed price of its underlying assets. And then we also did have exposure to other areas of the South African market, which continue to remain under pressure as a result of the local climate. But some of those stocks are trading at extraordinary low levels, and we do think that buying them at such low levels does protect you against further downside with an asymmetrical advantage in terms of the potential unlock. Some of the new stocks in the portfolio included a US retailer by the name of Kroger. That's the largest US grocery chain, which we believe is well positioned to actually continue to do well despite Amazon coming in on the grocery side. They've actually bought a stake in Ocado, which is an online business, and they have very good geographic locations. So we might see an increased prevalence of that click and collect model, where in the US you want the advantage of the online shopping, but you don't want to have to be at home to receive your groceries. So you buy your groceries online and you collect them effectively on the way home. And their location of stores is really optimal for that. So we don't think Amazon is going to completely take their market share. We think at this price, they really represent a fantastic opportunity. Local retailer Truworths also made its way into the portfolio. Like many retailers in South Africa, they've had a combination of bad economic conditions and some mistakes on management's part. They bought the UK chain Office, which gave them exposure to the UK, which has also been under pressure. But also they introduced the stores to South Africa, and it's been a bit of a disaster, and they've actually had to reverse that and actually cut their costs there. So they're now trading at extremely low levels, and we believe that it was time to actually introduce a small allocation to that stock as well. So the fund does still have more global exposure. It's got a wide array of undervalued opportunities across different geographies, across different sectors. It's got exposure to different currencies, which we think are undervalued, and we think it's well positioned to protect against any sort of downside in global and local markets, and very well positioned to provide absolute returns above inflation over time. This fund we've been managing since 2003, and during that time it has achieved its objective of generating inflation-beating returns of just over 6% above inflation per year since 2003. So we think that this fund will continue to do that. And the interesting thing with this fund is that it performs differently to the market, and that will provide very good diversification benefits in combination with other funds as well.